Good afternoon and welcome to the CT Global Managed Portfolio Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company can review all the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Paul Green, Fund Manager. Good afternoon to you, sir.
Good afternoon, and good afternoon, everybody. Thank you for joining us this afternoon. Welcome to the webinar on the CT Global Managed Portfolio Trust. My name is Paul Green, and I'm joined here today by my colleague and co-manager on the trust, Adam Norris. We've been managing the trust since the 1st of June this year, which is the new financial year. But I've been investing and been involved in the management of the Columbia Threadneedle open-ended funds for the last 18 years. And before that, we worked on multi-manager funds at Credit Suisse Asset Management for 6 years. And I've got over 20 years manager selection experience.
Good afternoon, everybody. I'm Adam Norris, and as Paul said, myself and Paul have worked together for over 10 years now, focused on manager research and manager selection, but also investment trust selection as part of that. And today in this webinar, we're going to run through different parts of our investment process. So we'll look at the building blocks which go into the investment process, the real focus when it comes to investment trust selection. We'll look at some of the market trends that we see going on at the moment, as well as covering areas such as the investment trust industry and its current state of play. But before we do that, we'd just like to say a very strong and big thank you to Peter Hewitt, who has been the portfolio manager on the trust since its launch in 2008. He's demonstrated great passion, enthusiasm for the industry. I'm sure he'll remain an active participant, but we wish him well in his retirement from portfolio management from the end of May this year.
Okay, so before we get into the process and the portfolio update, it's worth just recapping on some of the key attributes of the CT Global Managed Portfolio Trust, which aims to be a long-term savings vehicle for private individuals, really designed to be a one-stop shop for investment trust exposure. It's a conventional investment company structure, but uniquely it has two shares. So it has the growth shares and the income shares. The objectives of these aren't changing. So for growth, the objective is capital growth. And for income, the objective is an attractive level of income with the potential to grow that income and capital growth over time. The current yield on the income portfolio is around 6.5%. There's a couple of other unique features to this trust. The first one is the transfer of income from the growth portfolio to that of the income portfolio. So for any dividends that are received from the underlying investments of the growth portfolio, they get transferred over as income to the income portfolio, and a corresponding amount of capital comes back to the growth portfolio. And that really helps boost the dividend of the income. And then there's also an annual conversion facility for shareholders. Once a year in October, investors are able to transfer their shares from one share class to the other. So, for example, if you've been an investor in the growth portfolio for a number of years, obtaining capital growth, and then you reach a certain stage in your life where you think a bit of extra income might come in handy, you can use that conversion facility to transfer your shares over at minimal cost to the income portfolio to achieve some income, and vice versa. And then the final point is tight discounts. So what we're trying to do here, because it's a trust of investment trusts, we're trying to avoid the double discount. Because a lot of our underlying investments are trading at discounts, we try and maintain our own share price close to that net asset value to avoid that double discount. So that's the attributes of the trust, but why should investors consider investment companies in the first place? Well, we're just putting out a few examples of why we think it's worth looking at investment trusts at the moment. First one is the purist approach. And what do we mean by that? Well, the closed-ended nature of investment companies means that investment managers are really able to reflect their high conviction portfolio, their truest approach to investing. So, for example, if you think of the Aurora UK Alpha Trust, managed by Gary Channon and his team, if you look at how concentrated that portfolio is, it really is a collection of their very best ideas. In fact, the top 2 shares in their trust represent 30% of net asset value. It's very difficult to get that kind of concentration in the open-ended space. Discount opportunities. Well, discounts are in abundance in the trust sector at the moment, and there's a rich seam of opportunity to exploit. And just as a reminder, if you've got an investment trust trading at a 20% discount, for example, that essentially means you can buy £100 worth of assets for every £80 you spend. And then access to private markets. You may read and hear a lot about private investments and how they can offer some diversification to portfolio, but how do you get access to them? And there's a plenty of choice in the investment trust sector. And some of those are incredibly well managed vehicles. And there was quite a bit of excitement coming into 2025, which was set up to be a pretty exciting year for realizations, for exits, and for IPOs. And private equity trusts tend to react quite well when you've got a show of value. However, because of the volatility this year, it's meant that that's dried up a little bit. There hasn't been a huge amount of IPOs this year. There hasn't been a huge amount of exits, which means that private equity trusts are trading on meaningful discounts. We believe that's a very good opportunity for patient investors. Fourth point is the ability to gear. It's another function that sets trusts apart from open-ended funds. This can enhance returns, particularly when it's done in a dynamic fashion. So, for example, Alex Wright, who's the manager of the Fidelity Special Values Trust, he substantially increased the gearing in his portfolio during the downturn in COVID, probably when it felt like the worst time to do so. But that really enhanced returns as markets recovered. And then independent boards and engagement really go hand in hand. Independent boards are there to look after your interests as shareholder. It really adds another element of due diligence for you as an investor. And engagement, we've been investing in investment companies as part of our open-ended multi-manager funds for the last 10 years or so. And over the years, we've engaged with both management teams and boards on the likes of capital allocation, discount policy, and also strategy. So now we're going to turn to the process that myself and Adam will be implementing on the trust. And over the next few slides, we'll be covering the likes of building blocks, how we come to allocate within the portfolio. We'll be looking at investment trust selection, how we meet the managers, what we do after that, and how we use analytics, both in terms of trust selection, but also portfolio construction. So starting off with building blocks, Adam and I are part of the multi-asset team at Columbia Threadneedle, who look very closely at the best markets in which to invest over the medium term. They spend time looking at things like fundamentals, valuation, behaviourals, so that they can really allocate their portfolio to take advantage of tailwinds on a medium-term view. And strategic asset allocation is essentially just an industry term to describe how you invest your portfolio over the medium term across geographies and asset classes. And we're going to use their expertise to come up with a strategic asset allocation for the portfolios. Investment trust selection and portfolio construction will be covered by Adam over the next few slides. But in terms of tactical asset allocation, again, it's another industry term, but it just means how do you allocate in shorter term? There's always volatility in markets, and rather than just stick with your medium-term or long-term view of where you need to invest, volatility can really throw up some attractive opportunities in the short term. And as part of the multi-asset team, we're alive to those opportunities as and when they come about. A recent example would be adding to emerging markets and reducing some Japanese and some European equity exposure. So I'll pass over to Adam now, who will talk a bit about our investment trust process.
Yeah, thank you, Paul. So at the heart of our investment process, much like Peter before us, is meeting managers of investment trusts, understanding their processes and philosophy. And we go to lots of different fund manager meetings. So we may meet some excellent and passionate fund managers in private equity, some very interesting fund managers in, say, infrastructure, and then subject matter experts when it comes to, say, UK equities. And we realise and recognise that there's many different ways for investment trusts to generate performance, and it isn't just about the manager, although lots of performance is. So we start off with the asset class. We think we stand back and say, how much do we know about the asset class? How do we know how it functions and how it behaves through time, when it is strong points and its weak points? And then we focus on the investment manager themselves. So this is more about the investment process of the manager. How well resourced do we think the wider team is? How strong do we think their stock selection skills are? And have we seen evidence of that through time? And then more subtle factors as well, such as what's our view of the culture of the investment manager? Corporate governance, increasingly a focal point when it comes to investment trust performance. We look at the board, we try and understand their relevant experience and really how shareholder friendly they've been through time, and what measures have they implemented in order to potentially close discounts, and thinking about shareholder returns over the medium term. And then lastly, structure. We think about the diversity of the shareholder register, also other factors such as the market cap or the total assets of the investment trust, and how relevant is that compared to the opportunity set. For instance, in UK small cap, would we want a very large trust operating UK small cap? We'd prefer smaller and more nimble trusts. And we go through this as somewhat of a checklist to be able to make sure that we understand the different facets of the investment trust, but it helps us really standardize different trusts across different asset classes into a single score that we can debate. And similarly, we use analytics when we're trying to understand investment trust performance. When we're meeting with fund managers, again, which is the central point of our investment process, they may say areas to us such as, I prefer companies which are more faster growing than the market, or a manager may say comments like, my portfolio is very cheap and is the cheapest it's ever been. Well, we can test that through time. We can receive the portfolio manager holdings. We can upload them to this analytics tool here shown called Style Analytics. It helps us track different positions through time, and we can really verify the manager's words. We also use it as a portfolio construction tool. So if we upload all of the different investment trusts, equity trusts that we are reviewing, we can see how much overlapping exposure there is between different managers, different styles, different geographies. So in that bottom right-hand side there, where there's lots of reds and blues, this is a sort of model portfolio, a dummy portfolio that we've put into the system. And what we're trying to do is make sure that the portfolio is very diversified. So the blues and dark blues and light colors represent more diversified investment trusts, and the dark reds more overlapping and correlated exposures. And again, what we're trying to do, and what we'll be trying to do through time, and we'll come back to, is try to reduce some of these overlapping exposures where possible, and try and lean into more diversified exposure, both globally and across different asset classes.
Okay, so just to recap on the investment trust process, so building blocks, both in terms of short-term and medium-term asset allocation. Investment trust selection, there's going to be a huge amount, and there has been a huge amount of meeting investment trust managers. It's something that Adam and I love and have always done, both in the open-ended and closed-ended space, and how we use analytics. And when we bring all that together, we think over time it's going to lead to a higher conviction portfolio, but still globally diversified.
So just on more macro type themes at play, I see we've had a question on the US dollar. Perhaps I can address it through these points here. I guess the most headline noise and news that we see at the moment is around tariffs. The US administration coming in with a tariff policy, really trying to address some of the imbalances that they see in the US trading system. And as part of the multi-asset team within Columbia Threadneedle, we did a lot of work on what tariffs actually mean for the market and companies and their corporate profits. And we took the view relatively early that within, say, US equities, very little sensitivity actually to tariffs. If you think about the composition of the US market, large technology names, not necessarily good producers, that actually the hit to corporate profitability would be measured, not necessarily overdone. And so that's helped us stay invested through this period. If we think about the US dollar, that is something that's definitely been affected by tariffs, and that's obviously an effect when you're investing overseas in, say, US equities translated back to sterling. But similarly, it's creating opportunities that we find. So within emerging markets, a weaker dollar is generally beneficial for emerging markets, and we think with emerging market profitability staying relatively robust through this period, a weaker dollar should be stronger for emerging markets. And then lastly, on UK PLC, well, I'm sure we all know that UK economic growth has been quite difficult to find over the last 5 to 10 years now. And UK corporate profit growth as well has been relatively challenged for a number of years now. And so if we look at the investment trust market as well as the UK market, actually we've seen some quite strong performance from UK equities, and we'll come back to it, but we've been using some of this strength to actually trim some of the positions within the portfolio trust. So whilst they're more macro type themes, if we think about actually portfolios, we think US earnings are likely to remain robust. I think some of the technology names which have really powered global markets over the last 10 years, well, they're still producing earnings and still growing quite strongly, particularly versus the wider market. So if you think about that from a trust perspective, Polar Capital Technology Trust, which has been a strong feature of the growth shares for a number of years, remains a strong component and will likely remain a strong component whilst we see those US technology names still producing. But similarly, within the income shares, we can capture some of that exposure too. So we use, say, Global Income Trust there. For pick out JP Morgan Global Growth and Income Trust, really exposed to the top end of the US market, still see very strong value in US technology type names. And so still able to capture that through within the income shares too. I've discussed emerging markets, a weakening US dollar. Like a staggering statistic is that emerging markets in aggregate haven't grown their earnings per share for over 10 years now. So no earnings growth in emerging markets for 10 years. And we think emerging markets could be poised for some performance with that gently weakening dollar now. And so how do we address that within the portfolios? Within the growth shares, we've been adding to Mobius Investment Trust, and within the income shares, JP Morgan Global Emerging Markets Income. And Paul's a big film fanatic, and so we've been trying to use a film reference of Jerry Maguire, Show Me the Money, when it comes to private equity exits. Paul articulated earlier about how exits really drive the flywheel for private equity. You tend to see good pops in performance when private equity managers are exiting deals, and that's really slowed. The IPO market has slowed dramatically. Exits on the whole are few and far between. And so what does that mean? That means that private equity funds or the investment trusts are really pent up with value. And so we see some strong pent up value across the board. Meanwhile, the discounts to net asset values are still close to multi-year lows. And then lastly, within alternatives, over the last 10 years, we've seen a growth in alternatives when it comes to the investment trust market. Lots of yield type companies or alternative income type assets, be it from renewable energy generation to infrastructure assets. And whilst over the last 10 years, these have been good income generating assets, maybe not capital, but really focusing on income, with large discounts to net asset values, we see them as total return opportunities currently. We've picked out Cordian Digital Infrastructure there as a new holding, and we'll come back to that in a few slides' time.
Okay, so Adam mentioned discounts there, and I mentioned them earlier. And this is a slide I think regular viewers will be familiar with. Peter's used this before. It shows the investment trust sector discount, and the one on the left-hand side shows it over 10 years. And you can see that up until the end of 2021 into 2022, it was trading at pretty close to net asset value, maybe a discount of 3 or 4%. And then due to the heightened issuance of shares over the preceding years that Adam referred to there, at the same time as interest rates going up quite sharply globally in an attempt to curb inflation, we saw the discount widen out to around about 15% for the sector, and it stayed there pretty much since then. There is some better news. If you get your magnifying glass out and look on the right-hand side, shows the same data, but just over 2 years. And you can see the leg down in March there and the sharp rebound. That was the volatility around Trump's tariffs. And since then, we've seen a very gentle discount closing. We're not necessarily calling the bottom, but it's certainly positive to see. And we've used some of that discount closing, as Adam mentioned, within the UK space in particular, to trim a little bit of exposure there. So turning now to the growth portfolio and the top 10 holdings. If you look down the list, you'll see a varied selection of trusts, including UK all cap, UK small cap, private equity, including Oakley Capital Investments and HG Capital Trust. Also global technology holdings and broader global trust. But when you add up the total of the top 10, it comes to under 40% of the portfolio. And as we move forward, myself and Adam are likely to lean into our higher conviction names with the help of the analytics that he spoke to earlier, removing some of those overlapping positions, leaning into our best ideas. We would expect over time the portfolios to be more concentrated and the top 10 to account for a larger part of the net asset value. If we turn now to some of the changes that we've made recently, we've been adding to Oakley Capital Investments. It's now the largest position in the growth portfolio. We've been adding some new positions as well, although they're not fully scaled. So we'll be able to talk about these in more detail next time we update you. And to make way for those investments, we have been trimming, as I mentioned, just a little bit of exposure in the UK equity space, both large cap and multi cap.
So we touched on that Oakley Capital Investments, the largest single holding in the growth shares. And what is it that makes it attractive to us? Well, first and foremost, it's been a long-term holding of the growth shares, so it's not a brand new position. We've just been adding to it through the month of June. I think at the heart of what makes Oakley Capital an exciting investment is that Oakley Capital partner and invest alongside entrepreneurs around Europe. So it's not just a case of private equity own the company, adapt it through time and exit. They really want to partner and grow the value together. And the Oakley Capital performance, if I think about the share price perspective, over the last 5 years has handsomely outperformed the MSCI World. And that's with the MSCI World almost doubling over that time frame. So some really strong long-term performance, yet still Oakley Capital trades at a 30% discount to its net asset value. We talked about exits really driving private equity. And whilst this isn't a read across to the wider portfolio, Oakley Capital recently announced that a sale of its holding at a 300% premium to where it was carrying. So yes, don't expect the portfolio to treble from here, but at least an indication of the types of strengths of the portfolio assets. One of the largest single holding is a company called North Sails. Now, North Sails, think of it as high-end engineering, but for sails, for yachts and boats. And whilst there's a large single direct holding, Oakley Capital looking to reduce that over time and freeing up capital for other areas. So if we think about our investment trust scorecard, which we talked to earlier, when it comes to that corporate governance, what can boards help do and do with cash that's freed up, potentially buy back shares, potentially start the flywheel of more investments within private equity or all of the above. I guess the cherry on top is we attended the Capital Markets Day recently, hosted by Oakley Capital. And whilst that's excellent to sort of hear from the portfolio managers and other components of the Oakley Capital company, what's really interesting is hearing from the underlying portfolio companies coming to present. and why they want to be there. And why do they want to be there? They want to be there because they want to partner with Oakley Capital, not necessarily just sell a business and move on. Oakley Capital wants to partner with them, keep them there, and continue to work alongside entrepreneurs. So qualitatively, scores quite well for us. So it's now the largest single holding in the growth portfolio. Again, that's going to be dynamic through time. We don't expect that to be forever the largest single holding, but for now we think there's some really strong value. And then similar to the growth shares, so this is the top 10 of the income portfolio. Still a broad spread of different types of assets, so remaining well diversified, be it UK income, global equity income, private equity, infrastructure. And much like Paul said, we expect this top 10 to represent larger parts of the portfolio through time as we lead into our best ideas. And coming on to some of the activity since we've been portfolio managers since the start of June, still building some of the new positions within the income shares. So perhaps we can come back to those at the next webinar that we host. One that we've been adding to is biopharma credit. Why is it relevant for the income shares? Well, it pays a 7p dividend target through time, and that's its base level. But it provides debt or loans to biotech industry, lots of it in the US, but globally is their remit. And when those loans prepay, not only do they get all of their assets back, all of the money back, but they're usually structured with prepayment fees. So through time, you'll be able to see biopharma pay special dividends through time, enhancing that income for shareholders. Now, biopharma credit have recently announced 2 large repayments. And so we estimate that around 25% of their portfolio is in cash at the moment, which underpins that dividend that we've just been talking about. And then similarly to the growth portfolio, we've been trimming some of the UK equity trusts within the income portfolio to just make way for some of the new portfolios, more new positions that we've been building. And I've left it till last is Cordiant Digital Infrastructure. It's an entirely new holding for the income shares. And why do we think that's an attractive place to invest our shareholders' capital currently? Well, I'm sure you, as well as I, are increasingly using data in everything that we do, be it from mobiles, be it at home, or be it webinars as we're hosting today. Our data usage is just increasing year after year after year. And what does the investment trust invest in? Well, it owns established backbone of that data infrastructure, be it towers or network companies. And these are relatively stable and growing cash flows. So it's able to pay a dividend to us as shareholders. But crucially, it's not just about paying dividend to us as shareholders. It can grow its value through time by reinvesting the extra cash that it earns into fast growing areas, be it financing areas into such as the cloud or data centers, which are increasingly becoming larger parts of the infrastructure market. If I refer back to our investment trust scorecard that we referenced earlier, when we think about the investment manager and their approach, we also like to think about how much alignment of interest the manager has alongside us as shareholders. And the key individual or key manager at Cordiant Digital Infrastructure is Steve Marshall. He's the former president of American Towers, which is a very large US towers business. Well, he owns 13 million shares alongside us as shareholders, so has strong alignment of interest with us too. And not only does the trust pay a strong dividend at 4.5% dividend yield versus the FTSE All Share, so a premium yield, but also is able to grow its capital, investing in data centers and other areas. So that's a really strong both growth in capital and hopefully growth in our income through time.
Okay, turning to portfolio performance now. The performance goes up to the end of the financial year, which was the 31st of May. Given that we've been managing the portfolios from the 1st of June, the next time we present, we'll be able to reference the period from the end of May. The next slide shows the longer term annual performance of the trust. And then in terms of a summary, so the CT Global Managed Portfolio Trust is a one-stop shop for investment trust exposure. Some of the key features will remain unchanged. That is the objectives, both the growth and the income shares. The CGT-friendly option for investors to switch between shares once a year in October. The transfer of income accrued and received in the growth portfolio over to income in return for capital, and the maintenance of tight discounts.
I think, as we've said a number of times through this presentation, we hope to give a higher conviction approach to the investments. So those top 10s should over time represent larger exposures within the portfolios. And why do we feel able to do this? Well, as we've discussed, we're part of the well-resourced Columbia Threadneedle multi-asset team, so we can take a view on both geographies and asset classes. Myself and Paul, as well as other individuals within Columbia Threadneedle, can work on the investment trust selection. So that really is meeting managers and referring back to our investment trust scorecard to be able to standardize that across different asset classes and geographies. And then more shorter term, could be a discount opportunity, tactical asset allocation, which can help drive performance too. And I'll speak on behalf of both Paul and myself when we feel very privileged to be the portfolio managers as of the 1st of June this year for the Managed Portfolio Trust. And not just as portfolio managers of an investment trust, but because we see tremendous value within the sector. Referring back to Paul's slide earlier about the average discounts, we can start to see some reasons for change, and also for the wide opportunity set that the investment company has. So I think we'll sort of stop our presentation there, and thank you for listening, and open it up to Q&A.
Thanks, guys. Paul, Adam, thanks very much for your time. It's been very interesting and insightful how you're going to start the portfolio, the management of the portfolio from now. We've had a few questions, and I'll encourage viewers and listeners to add any questions they wish for us to address in the Q&A area of the webinar. You can also download the presentation at any time to see a bit more detail on the slides. We'll start, I think, with, we've had quite a few questions. We'll start, I think, with the UK. We read lots about the UK market being cheap, but you've been reducing your UK equity trusts. Can you please give some detail on why that you've been selling that down a little bit?
Yeah, I can take that one. Yes, I agree. The UK market does look cheap, but it depends on which way you cut it in terms of the index. Obviously, we saw just yesterday the FTSE 100 go through 9,000 for the first time. As I mentioned, as part of the multi-asset team's analysis, we look at the likes of fundamentals, which sort of look okay. Valuations look reasonable, particularly against other markets. Behaviourals, perhaps less so. I don't think we've seen some of the outflows slow down recently, but we haven't seen a huge amount of attraction from overseas investors into UK assets. It's not saying there isn't value on offer. In fact, we're finding a decent amount of value down the cap scale. So in terms of mid and small cap opportunities, we think that they're looking quite attractive. But in terms of the large cap exposure, that's where we've sort of done most of our trimming.
Thank you. There's been a couple of slides suggesting how the discounts widened out quite considerably over the last 3 years or so since maybe COVID. This has obviously affected performance as the share price has gone to a discount versus the FTSE All Share, which clearly does not have a discount issue. But the question is, how does the new management plan to reposition the portfolio following the underperformance over sort of a 3 to 5 year period? What specific changes have already been implemented? I think you've suggested about a more concentrated top 10, but if you can go into a little bit more detail about how you're going to start repositioning, if that would be helpful.
Yeah, sure, I'll take that. So, so just in terms of the understanding, just to clarify, both sets of shares run a relatively tight discount control. So you're right about the FTSE All Share not necessarily trading discount. It has been a sector issue. So I'll take that point first, and then come back to what do we intend to do on portfolio construction. If I go back to our investment trust scorecard, which really is a sort of backbone for our investment process, that focus on corporate governance as a distinct part of that is increasingly becoming part of the toolkit for lots of investors, but also a reason why we think that investment trust discounts can change from the current status. And that is that boards on the whole are starting to be more aggressive when it comes to changing it could be changing the manager, it could be merger and acquisition with another trust, it could be selling assets and buying back shares. So back to Paul's analysis earlier about buying £80 worth of buying £100 worth of assets for £80, and we're seeing more and more of that, and that's highly accretive, we think, for shareholders. So that's a reason why one reason why things are starting to turn. And in terms of performance, obviously what we can control the portfolio going forward, and what do we intend to do? Well, it really is try and lean into those best ideas that we find. We want individual holdings to really be able to contribute performance, and we think if we're doing lots of the work in terms of both meeting the managers, in terms of Columbia Threadneedle, the team we're part of, in terms of strategic and tactical asset allocations, or hopefully that we can generate strong performance in the coming time periods. But it still is a lot of sort of shoe leather work. We still meet with managers all the time. We prefer to meet face to face, and so there's a lot of work that's still going into it. But really is that higher conviction approach as to why we think the trust can deliver performance going forward.
Excellent. We'll look forward to that. So on to yield. Obviously, the income class is the yield is very important to the shareholders of the income class. How sustainable is the income 6.2% yield, given pressure on income sectors like property and infrastructure? And I'll add a second question from someone else. Do you have a target annual yield internally, as in not paid out in dividends, for the income portfolio?
Also on the first point, how sustainable is the yield? So there's two parts to that. One, we think there's some really tremendous total return opportunities within alternatives at the moment. So if we think about be it some of the digital infrastructure, which I discussed earlier, renewable energy infrastructure, particular trusts look reasonable total return opportunities there. And then coming back to the feature that Paul mentioned earlier, it isn't necessarily just the income of the income portfolio, because the trust has that unique position where income and in the growth portfolio can be swept across for returning capital, is able to boost the yield of the shares. So we don't see necessarily a reason to be fearful of the yield or income generation, because we see strong total return opportunities across the piece. And sorry, could you repeat the second question, Pete?
Do you have a target annual yield internally for the income, not necessarily what you pay out to investors, but what you would like the portfolio to yield?
We don't set a sort of yield target on an aggregate level. I guess what we're trying to do, the income shares have been a progressive dividend payer for the past few years, but we don't pin the yield on an aggregate portfolio level. That could lead us into areas which we're owning just to generate yield, and that's not what we're trying to achieve here. We want to be able to generate total return opportunities. It just so happens that at the moment, particularly within alternatives, that we see some really strong opportunities. So we're pretty comfortable with that. I don't know if you've got anything to add, Paul.
No, not at all. But also there are some dividend reserves as well we can use if we need to. But in terms of a target yield, no, we don't have one.
it doesn't lead a decision process then, by the sound of things, which is comforting.
Yeah.
Moving on to renewables, we've had a few questions on renewables. I'll briefly summarise all of them. Any observations or comments on impact environmental markets? I know you may not want to be dragged into any single name, but with that, why not a larger exposure to renewables given the high discount and strong yield? And the third question, are you still positive on the renewable sector as a good dividend payers? Can you rely on them to be continuous dividend payers?
Yeah, so I'll take the renewable questions. We are pretty sanguine when it comes to renewable energy infrastructure, in that there are optical discounts at play. There are discounts in specific investment trusts and high dividend yields. That ordinarily, what I'm hesitating is because ordinarily that isn't necessarily something that we're just going to go, yeah, great, let's own them. Coming back to our investment trust scorecard, when we think about the asset classes, there are lots of different inputs which go into the valuations when it comes to renewable energy generation. And coming back to the previous answer again, we wouldn't want to buy a trust just for yield only. But but it does feel like there's sort of some peak pessimism when it comes to around the renewable energy trusts. What we would like to see more of are asset disposals. If we think about property, some of the property parts of the investment trust market, there's been a number of disposals moving on, M&A, trust mergers. There's been few and far between actually within renewable energy infrastructure. A couple of trusts have been taken private. So we'd like to see more asset disposals, more kicking that flywheel of capital allocation into place. So whilst we are sanguine on the sector, I think for us to get even more upbeat in it, we'd like to see some of those asset sales, and for the board to be able to recycle the capital for investors.
Yeah, there was some positive news last week because there was a threat of zonal pricing, which would have caused some potential issues for some of the renewable names. But that's the government have confirmed they're not looking to implement zonal pricing now, so that's a positive for the sector as well.
Lovely. So all these wide discounts across the sector, what's the catalyst for these discounts to tighten in the alternative space, at least, in your opinion, of course?
Yeah, I mean, sorry to sound like a broken record, but it really comes down to corporate governance, and it comes down to boards being able to help act on behalf of shareholders to recycle, subscale trusts necessarily. Looking at different ways to realise value. It could be through merger and acquisition, could be returning capital to shareholders. So it really comes back to that corporate governance point. But we are on a better trajectory when it comes to corporate governance, and I think that's only a good thing for the sector. So I don't think there's a silver bullet. These things working stages. All we can do is really try and expose the portfolio to what we think is genuine value and genuine value opportunities, and hopefully over time you'll start to see that, particularly when it comes to some of the larger names in the portfolio.
And of course, you've got some unknowns like regulatory issues like cost disclosures and things that might help the sector in the medium term. But anyway, on that note, thank you very much, both of you. If I can ask Paul first and then maybe Adam to give some closing comments about the trust, and then we'll pass back to the moderator.
Yeah, thank you, Peter. Just really echoing Adam's comments earlier. We're both very excited to be part of this trust and managing the trust from the 1st of June. Excited about the opportunity in the sector, and we look forward to hopefully generating strong returns for investors.
And just a thank you for listening from me. Hopefully you've learned a little bit about our investment process and we plan to position the portfolios going forward. And thank you everybody for your questions.
Thank you.
That's great. Well, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order the management team can better understand your views and expectations. On behalf of the management team of CT Global Managed Portfolio Trust PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.